Another earnings beat coming in for ICICI Bank, and the bank beat street estimates with a healthy asset quality for Q4. The net interest income has come in line, largely in line with estimates, while provisions has beat expectations. My colleague Harsh joins in with the key highlights.
Well, yes, the numbers for ICICI Bank reflect a good set. When I'm looking at the net interest income, it's expanded to 17,667 crore, which is a solid 40% growth. We're expecting something around 39% on a year-on-year basis. We're seeing operating profit as well expand, but slightly lower than anticipated. That really shows that the OPEX has gone up for the bank in this particular quarter, and pretty much in line with how HDFC is growing its OPEX. So largely, we're seeing the large private sector banks really invest in good times. At least that's what it is at the moment. We're seeing 34% growth with regard to operating profit. It's come in a tad below expectations, as I did mention. We're also seeing provisioning come in much healthier than expected. So provisions have come down. 2,257 crore was the provisions number in Q3 of FY23. It's come in at 1620 crore in Q4. That's a very solid reduction. And we were anticipating, or we had put a number of 2,000 crore on that provisions number for ICICI Bank. So it's coming well below our expectations as well. In terms of where the GNPA ratio is moving, it's moved from 3.07% to 2.81%, a very healthy move, much better than anticipated again. The NNPAs also have moved in a very healthy fashion, down from 0.55% to 0.48%, so 7 bits improvement even there. And we're seeing the PAT having expanded. Really no impact of that OPEX on PAT, largely on the higher OPEX on PAT, largely on the back of better provisioning or lower than expected provisioning that's come through. So PAT has come in at 9,121 crore, which is a solid 9.5% expansion on a sequential basis and 30% growth on a year-on-year basis. The NIM has also expanded, which is a positive. And we're seeing good growth on both sides of the balance sheet, largely in line with expectations. 19% growth on the advances front on a year-on-year basis, deposits growing around 11% on a year-on-year basis. But the telling part here is that when I'm looking at it sequentially, advances have gone up 4.5% and deposits have gone up 5+%. So for the first time in a long time, we're seeing advances growth slightly lower than the deposit growth on a sequential basis, which is something which is telling.
Let's listen into what the management had to say on their Q4 earnings as well.
Given the position of our balance sheet, as the repo rates have been increasing, the loan book sort of reprices faster than the borrowings. And I think with repo probably at the peak or near peak, the further expansions on the income side is certainly it has already taken place. Now the catch up on the borrowing from the deposit side will take place. So obviously, we do believe that somewhere the NIMs is near peak, and there would probably be a downward bias as the year progresses. So that is on the margin side. Secondly, which is very normal in the overall scheme of things, and we are very comfortable with the way we have positioned our balance sheet in terms of delivering overall core operating profit. Given the overall macro level, uncertainty, in terms of our book, as we have disclosed, we probably have the lowest NPA ratio of about net NPA ratio of 0.48%, and we are not seeing anything on the book side, but on a prudent basis, it is always good to be prudent on these things.